So you open a financial trading chart, and instead of a roadmap to wealth, you're just staring at what looks like the heart monitor of a highly caffeinated alien.
Yeah, that is a painfully accurate description.
Right. Like if you were sitting at your desk right now, sweating over a 5-minute chart with, I don't know, 14 different indicators blinking at you, you already know the exact frustration I'm talking about.
Oh, absolutely.
Those zigzagging lines feel less like a navigable map and more like just absolute unpredictable chaos. And you sit there wondering how the professionals, like the real money, actually look at this mess and know exactly when to pull the trigger.
Well, that information overload is honestly the primary reason so many independent traders feel like the market is just a casino. I mean, they are agonizing over the noise of the lower time frames.
Sweating over every tiny tick.
Exactly. And by doing that, they are completely missing the actual signal that's happening right above their heads. Because the objective isn't to, scout pennies while glued to a screen for 8 hours a day fighting the chaotic chop.
Which sounds miserable anyway.
Yeah. Right, it is. The actual goal is to trade alongside the smart money. And by that, I mean the massive financial institutions and central banks.
Which brings us perfectly to the core mission for today's deep dive. So consider this a one-on-one mentor session for you, the listener.
I like that approach.
Yeah, we are stripping away the confusion, the noise, all of it, to unpack the exact, systematic, step-by-step process for identifying and executing high-probability swing trades. We're going to decode the specific methodology taught in ICT, the inner circle trader concepts.
Which can be super intimidating for people at first.
Oh, totally. The jargon is intense. So that means we're breaking down that dense terminology into a foolproof top-down trading plan. A plan that genuinely only takes a few minutes a day to manage.
And the foundation of this systematic approach, it actually starts really far away from all that noise we were just talking about.
Okay, so where do we start?
Well, before anyone even thinks about looking for an entry or clicking a button, the very first step is defining the overarching current of the market. You have to lock in your market bias.
Macro view.
Exactly. And that process happens exclusively on the highest time frames. So we're talking about the monthly and the weekly charts.
Right, because the monthly and weekly charts are really the only places where massive institutions cannot hide their footprints. I mean, think about it. When a bank has $1 billion to deploy into a market, they can't just sneak in through the back door.
No, they absolutely cannot.
They require massive liquidity, and their entry naturally creates displacement. So we aren't looking for subtle shifts here. We're looking for large, unmistakable impulse price swings that just aggressively leave a period of consolidation.
Yeah, that displacement is the visual evidence of institutional intervention. Like when price moves away from a level so fast and so violently that it leaves these massive candlesticks in its wake, creating what we call a trending profile that tells you smart money has stepped into the market with serious force.
It's leaving a crater.
Basically, yeah. But identifying that displacement is really only half of defining the bias. We also have to prove that this institutional tide is actually sustaining its direction.
I just think about it like trying to paddle a surfboard. If the monthly and weekly macro tides are rushing aggressively toward the shore, you do not turn your board around and try to paddle out to sea just because, like, a 5-minute chart looks like it's pulling back.
Right, you will get crushed.
You get completely wiped out. But actually, proving the tide is moving requires tracking institutional order flow. It's a measurable mechanic.
It is entirely measurable. We want to observe exactly how price reacts to specific previous zones. So if the monthly and weekly charts are making higher highs, the down candles need to start acting as undeniable support.
Okay, so when price dips back into those previous selling areas, it should basically bounce off them and rally higher.
Precisely. And conversely, if we observe that the up candles are acting as a ceiling, fiercely resisting price and pushing it down into lower lows, then the bias is strictly bearish.
So you're just tracking if the market algorithm is respecting or violating previous blocks of orders.
That's it. If down candles are continually respected as support, the algorithm is heavily in a buy program. And the unbending rule of this entire system is that you only trade in the direction of that confirmed macro bias.
No exceptions.
None. You never, ever try to pick the absolute top or bottom of a market against the higher time frame trend.
Okay, so once that direction is locked in, we move to the second step of the system, which is figuring out where to actually enter the water.
Right, the execution zones.
Yeah, we know the tide is coming in, but we need a physical map of the market to locate those entry points. And this is where we construct the PD array matrix, meaning the premium and discount arrays.
So the PDURA matrix is basically just a framework for quantifying value. And to map it, you identify the current dealing range. That's the distance from the most recent clear structural high down to the most recent clear structural low on your chart.
You just find the top and bottom of the current move.
Exactly. And then you take that entire price range and slice it exactly in half. That literal middle point is your 50% equilibrium line.
And everything above that 50% equilibrium line is the premium spectrum. It's the expensive zone. Like if you were a massive institution looking to offload an asset or take profits, you distribute up there.
Because you want to sell at the highest possible price.
Exactly. And everything below the 50% line is the discount spectrum, the cheap or, on sale zone. This is where smart money accumulates.
It really is just basic economics.
That's like a grocery store.
Yeah.
I am not buying my coffee when it's heavily marked up in the premium zone. I'm going to wait until it drops into the discount zone below that 50% line.
The challenge for most traders, though, is that the market below the 50% line isn't just this big blank canvas of discount prices.
Right, it's not a free-for-all.
No, there are specific algorithmic landmarks inside those premium and discount areas. And look, this is usually where the ICT jargon really overwhelms people, but the underlying mechanics of these concepts are strictly logical.
Well, let's translate that jargon into the actual physical mechanics of the order book then. Let's start with liquidity. In this system, liquidity usually refers to old highs and old lows, right?
Yeah, previous structural points.
So I look at those old structural points like a giant cookie jar of resting stop-loss orders. Like, think about the last time you, the listener, got stopped out on a trade, you bought a setup, and you put your protective sell stop right below the most recent low.
Which is what every textbook tells you to do.
Exactly. But to a massive bank algorithm, your stop-loss isn't protection. It is market fuel. A sell stop is quite literally a market order to sell. So if an institution needs to buy $500 million of an asset, they desperately need a massive pool of sellers.
They have to pair their orders.
Right. So the algorithm pushes the price down in that old low, triggers everyone's stop losses, grabs the cookies from the jar, and uses that sudden flood of retail sell orders to instantly fill their massive buy orders.
The algorithm is quite literally engineering liquidity. I mean, it forces retail traders to sell at a discount so the institution can actually accumulate. And once that massive order is filled, price rapidly reverses.
Which leaves a huge footprint.
Right, which leads directly to the next critical landmark we look for, the fair value gap, or sometimes called a liquidity void.
Yeah, because when the algorithm grabs that liquidity and shoots price in the opposite direction, it moves so incredibly fast. It's like an aisle at a grocery store being instantly cleared out by a mob of panic buyers.
That's a great visual.
Someone came in and bought every single item on the shelf in like 3 seconds, leaving a massive empty gap. On a chart, when price displaces violently and leaves a gap between the wicks of the surrounding candles, it creates a pricing inefficiency.
And algorithms hate inefficiency.
Exactly. The algorithm naturally wants to return to this gap to basically restock the shelves, offering fair trading to both buyers and sellers before resuming the macro trend.
Right, because the algorithm is literally programmed to seek efficiency. An imbalance, like a fair value gap, acts as a powerful magnet. The market will very often drift back into that exact gap to rebalance the books.
Okay, so that's 2 landmarks. What's the third?
The third major landmark traders need to map is the order block. And it is incredibly vital to understand how to actually identify a real one rather than just pointing at random big candles on a chart.
Right. An order block is the specific footprint of that institutional accumulation just before the major move. So if we are looking for a bullish order block down in our discount zone, we are looking for the last down candle, the last push of selling momentum, right before a massive explosive rally upwards.
But it's not just any down candle.
No, to validate it, the subsequent rally must cause displacement and literally break market structure. That specific down candle marks the exact price level where smart money stepped in to reverse the market.
Similarly, what we call a rejection block tells a story of aggressive defense. You usually find this in the really long wick of a candle.
Just a huge spike.
Yeah. The wick indicates that price attempted to push deep into a level, but the algorithms fiercely rejected it, leaving behind this really clear signature of institutional defense.
Okay, so bringing this all back to our systematic process. We defined our macro bias on the monthly. Let's say it's bullish. We pulled our dealing range, and we mapped out the 50% equilibrium line.
Yep.
We are absolutely ignoring the market while price is hovering up in the premium zone. We just wait for price to drop down into the discount zone, and we are hunting for one of these specific landmarks, an old load to be swept for liquidity, a fair value gap that needs restocking, or a bullish order block.
Exactly. But doing this correctly requires a highly disciplined top-down blueprint to actually plan the execution. The procedure moves through multiple timeframes in a very strict sequence.
Yeah, so?
Well, you start on the monthly chart, identifying your bias and mapping out your active premium or discount arrays. Then you step down to the weekly chart, and you basically transpose those exact monthly price levels over. Then you define the weekly arrays and transpose all of that down to the daily chart.
Okay, I have to push back here for a second
Wow.
because I've actually tried doing exactly this, and honestly, it is a nightmare.
Oh, the chart clutter.
Yes. If you draw every single fair value gap, every order block, and every single rejection wick from the monthly chart, and then you add all the weekly lines and then all the daily ones, your screen looks like a neon laser tag arena. It becomes this dense web of overlapping lines where you can't even see the actual candlesticks anymore.
Right. The map becomes entirely unreadable, and that chart clutter is the fastest way to induce severe analysis paralysis.
So how do we fix it?
The critical filtration mechanism here is the concept of nested arrays. You do not map historical data that price has long since moved away from. You only map the active, unmitigated arrays that are immediately nearest to current market price.
Oh, I see. It's like trying to find the perfect location for a billboard. You don't pull out a map and highlight every single road in the entire state. You are looking for the specific intersection where the interstate, the local highway, and the busy city avenue all cross at the exact same point.
A physical intersection is a decent way to look at it, sure. But think of it more like a Russian nesting doll to really understand the hierarchy of power here.
Okay, a nesting doll.
Yeah. What you are hunting for is convergence across time. When you locate a daily bullish order block that sits perfectly inside a weekly bullish order block, and both of those sit inside a massive monthly discount fair value gap, that is no longer just a line on a chart.
It's reinforced.
Heavily reinforced. That is an institutional stronghold. That is a fortified price level where the algorithms on the highest time frames are all in total agreement. That specific converged level is your target area.
I love that. We are filtering out all the noise just to find the heaviest overlaps, the exact zone where the monthly, weekly, and daily ties are all colliding in our favor.
Exactly.
So we've done our homework. We found our institutional stronghold on the daily chart. Price finally drops down into it. But we still aren't just hitting the buy button on the daily time frame, are we?
Definitely not. Entering directly on a daily, weekly, or monthly chart presents a massive risk management problem.
The stops would be huge.
Exactly. The sheer size of the price ranges on those higher time frames means your protective stop loss would have to be extraordinarily wide just to survive the normal everyday volatility of the market. You would need a massive account balance just to absorb the initial drawdown.
Yeah, I mean, a single weekly candle can easily fluctuate hundreds of pips.
Right.
Which brings us to the final step of the system, the execution phase on the lower time frames. I like to call it the sniper's perch.
Ooh, the sniper's perch.
Yeah. We use the monthly and daily charts like the wide lens on a telescope. They locate the correct planet, they find the exact continent, but you cannot land a rover using a wide-field lens.
No, you need precision.
Right. You have to wait for price to drift into that nested daily stronghold we just talked about, and then you click over to the 4-hour chart, your high-power lens, to really zoom in. You wait for a fresh 4-hour order block or a 4-hour fair value gap to form inside that larger daily zone. And that is where you actually execute the trade.
The telescope analogy works perfectly because it separates the where from the when. The daily chart tells you exactly where to do business. The 4-hour chart tells you when it is finally safe to enter.
And it completely shifts the math.
Oh, the mathematics of this specific sequence is quite literally the holy grail of swing trading. Because you are refining your entry on a 4-hour chart, your required stop loss only needs to be the size of a 4-hour structural low.
Which is incredibly tight.
Very tight. But because the underlying trade idea is fueled by a massive monthly or weekly momentum level, your profit target remains massive.
You are risking a 4-hour amount of capital to secure a monthly amount of profit. That structural mismatch creates these beautiful asymmetrical reward-to-risk ratios. I mean, taking trades with a 3-to-1 reward-to-risk ratio is standard practice, but by nesting a 4-hour entry inside a monthly array, finding a 5-to-1 or even a 10-to-1 ratio becomes a regular occurrence.
And that changes everything.
Let's really break down the math on a 10-to-1 ratio for the listener because it completely rewires the psychology of trading. If you risk $100 to make $1,000, you could take 10 of these exact setups.
Okay.
You could be completely, utterly wrong on 7 of them. You lose $700. But your 3 winning trades make you $3,000. You are mathematically wrong 70% of the time, and you still walk away wildly profitable.
It's amazing. And this mathematical reality completely removes the toxic pressure of needing a high win rate. You do not need to be right every single time you sit down at your desk. You just need to flawlessly execute the high-quality nested setups.
But we have to talk about the reality of those losses, because it happens to everyone.
Of course.
You find a beautiful nested setup, you zoom into your 4-hour sniper's perch, you execute the trade flawlessly according to all the rules, and then a random news event spikes the price and you get stopped out. What is the protocol there? Because human nature is to immediately hit the buy button again, to double down and force the market to give you your money back.
Oh yeah, that reaction, the classic casino tilt, is exactly what liquidates accounts. But this system includes a strict failure protocol that serves as a psychological safety net.
Which is desperately needed.
Step 1. Do not revenge trade. The market does not care that you are frustrated.
Harsh but true.
Step 2. Accept the loss, step back, and realize that the algorithm is very likely simply seeking deeper liquidity. It is reaching for a lower discount level. So you just wait for price to drop to the next active daily discount array below you, and you look for a brand new 4-hour entry.
But there is a really critical rule for that second attempt, right? You must re-enter using only 50% of your original position size.
Yes, absolutely critical.
So if you risked $100 on the first trade, you only risk $50 on the second.
Cutting the risk in half is a very intentional choice to preserve capital. You are deliberately refusing to force a full recovery in a single trade. Over time, the math of that asymmetrical reward-to-risk ratio will recover the drawdown, provided you just stay in the game.
You're managing your downside.
Right. Even a 60% mitigation of a previous loss is a victory, because it keeps your account alive to trade the next setup.
Okay, let's summarize this entire step-by-step masterclass for everyone listening. First, you lock in your macro bias by hunting for massive institutional displacement on the monthly and weekly charts.
Yeah.
Second, you slice your dealing range in half to map the PD array matrix. So you're only buying in the discount zone and only selling in the premium zone.
Right.
Third, you locate your institutional landmarks, the liquidity cookie jars and the fair value gaps, and you wait for them to nest together on the daily chart to form a fortified stronghold.
The nesting dolls.
Exactly.
Yeah.
And finally, you zoom into the 4-hour chart, wait for a lower time frame confirmation, and pull the trigger with a tiny stop loss to capture a massive 10-to-1 payout.
It is a profoundly robust, logical framework. But I do have to warn people. It demands the one resource most traders severely lack: absolute patience. A genuine, high-probability swing setup that aligns perfectly across the monthly, weekly, daily, and 4-hour charts does not occur every Tuesday. These prime conditions generally only materialize maybe once every 4 to 6 weeks per asset.
Wow. But think about what that actually means for your lifestyle.
Yeah.
4 to 6 weeks of waiting. That completely shatters the illusion that day trading requires you to be glued to your monitors, sweating over every single 5-minute candle.
It frees you.
It really does. If you follow this system, you literally cannot overtrade. You do your top-down analysis on the weekend, you set your price alerts at your daily strongholds, you close your laptop, and you just go live your life. You wait for the time frames to align.
And the overarching realization here is that the global financial markets are not driven by millions of retail traders drawing random trend lines on their screens.
Right. It's not a democracy.
Not at all. The markets are operated by massive banking algorithms coldly executing programmed mandates. They must seek liquidity to fill institutional orders, and they must rebalance pricing inefficiencies.
So as you look at your charts this week, don't ask yourself, what are other retail traders doing right now? Instead, adopt the institutional perspective. Ask yourself, if I were a banking algorithm with $1 billion to deploy, where would I absolutely need to drive price right now to find the stop-loss liquidity to fill my orders?
That is the exact right question. But, here's a thought to consider as technology continues to rapidly accelerate.
Okay, what's that?
Well, this entire systematic approach relies on identifying the predictable footprints of these massive banking algorithms. We know they need liquidity, and we know exactly where that liquidity rests. But as artificial intelligence becomes more deeply integrated into the retail sector, what happens when thousands of independent traders are suddenly using AI to front-run the banking algorithms?
Oh, wow. Because if everyone suddenly knows exactly where the cookie jar is, the banks can't use it anymore.
Exactly. The banking algorithms will have to adapt. They will have to engineer entirely new ways to trap retail capital, which honestly means the definition of a high probability array might fundamentally shift in the next 5 years.
The mechanics of liquidity will always exist, but the footprints might start to look very, very different. The map is always evolving,
Always.
which means our job of decoding it is never really done. But at least for now, that chaotic alien heart monitor on your screen doesn't have to look quite so terrifying. With a top-down systematic plan, it really just looks like a trail of breadcrumbs waiting to be followed. Well, thanks for joining us on this deep dive. We'll see you on the next one.